Departmental Accounts. Chapter 12, CA Intermediate of Paper 1 Accounting. In this session, we will learn what is departmental accounts and what is the basis of allocation of common expenses and what is the basis of cost at which material or goods transferred from one department to another department and accounting treatment. Basis of cost of transfer of goods from one department to another department and accounting treatment. Every organization will have various functionalities, various activities which are divided into various departments. Why it is required to divide among various departments is to have more control by having more information. If you don't divide the various departments and if you don't maintain the accounts as per departments, then the information that is available to the management will be difficult. If the organization maintains the accounts of various departments, then it is easy for the management to have control and accordingly they can intelligently and effectively maintain the business. That is the reason it is required to have department accounts. Now let us understand how many types of departments are there. There are two types of departments. One is dependent departments and another one is independent department. What is called independent department? Where the dependency of department on another department is less, then they are called independent department. That means they can procure the material by themselves, they can manufacture it by themselves, they can sell by themselves. There is no dependency on any other department. In that case, they are called independent department. Here, the allocation of expenses are very minimal and the process is very simple. And coming to dependent departments. Here, the dependency of one department on another department is continuous process. It is on regular basis. So here it is called the dependent departments. Depending upon the nature of the business, the departments will have to maintain different accounts so that they will be able to identify what is the cost and what is the revenue that particular department is generating, and accordingly they can evaluate their performances. In case of independent departments, the dependency of that particular department on another department is high. So here we will require the allocation of basis of allocation of expenses among departments so that we can evaluate the performance of respective departments and we can have control of profitability based upon the departments. Now let us understand what are the advantages of departmental accounting. Evaluation of performance, this we have discussed, that it will be easy for the management to have information if accounting is prepared on department basis, and accordingly they can evaluate the performance of respective department. And next, coming to growth potential of each department. When the accounts are maintained separately, it can be easily compared with other departments and they can reveal and they can evaluate. Justification of capital outlay. Say when their accounts are maintained between various departments, we know what is the investment in each department and what is the profitability in each department, and we can take the decision whether any department capital outlay is high or low, and accordingly the decisions can be taken. Judgment of efficiency. When the accounts are prepared department wise, then there is a scope to calculate stock turnover ratio, which says what is the stock which is maintained and what is the turnover it is taking and what is the ratio between and what is the efficiency, stock efficiency ratio, so that it can accordingly the decision can be taken. Next, planning and control. Availability of separate cost and profit figures for each department facilitates better control. Thus, effective planning and control can be achieved on the basis of accounting information. Because we have proper information, then we can have planning and accordingly controlling of the particular department, which enhances the profitability of the overall organization. Now, let us understand what are the methods of departmental accounting. There are two methods of accounting. One is accounts of all departments are kept in one book only, and another one is separate set of books are kept for each department. How these accounts for all departments are maintained in one book is that they can maintain in columnar basis. Department A, Department B, Department C, like this, and here particulars and expense amount, like this they can maintain. Each department wise the expenses can be maintained in a columnar basis, whether it may be day book or whether it may be ledgers. But in case of separate books of account, there will be separate set of accounts for each department. They will maintain in normal course, they will maintain their own purchases, sales, expenses, all these things. That is another method of accounting. Now, let us understand what is the basis of allocation of common expense. See, when there is direct expense, then there is no question of allocation, because it is directly incurred for that particular department. Then it is given, the cost is taken by that particular department. Suppose if there are any common expenses in departmental accounting, this is the main aspect, that dividing of allocation of common expenses. Basis of allocation of common expenditure among different departments. If expenses incurred specifically for each department are charged to specific department. Suppose we know any particular expense is incurred to that department, then there is no question of allocation. You need not divide or make some calculation how much cost has to be given. It is directly incurred. Suppose that particular department has purchased any raw material, then it is directly incurred for that particular department, so it is directly given to that particular department. Now, if there are common expenses, these common expenses have to be allocated to various departments. Now, how these common expenses are allocated? Now, there is general way of basis of allocation is given here. It is not hard and fast rule that if it is rent, rates and taxes, it has to be divided on floor area basis only. There is no hard and fast rule. Here there is a general way of allocation of common expenses is given. Management can decide depending upon their work, depending upon their working process of manufacturing or process of transferring goods and process of doing the business. They can decide any particular common expense on what basis it can allocate, which is more appropriate for way of allocation they can decide. Here we will go through what is general way of which is commonly applicable way of basis of allocation. Say for example, rent, rates and taxes, this and maintenance, insurance of building, this can be allocated on the basis of floor area occupied by each department. In case floor area is not given, then it can be allocated on the basis of time, how much time they have used that particular space, then that much time rent can be allocated to that department and accordingly to other departments. Lighting and heating expenses, consumption of on the basis of consumption of energy by each department. See, there will be a single bill which will be received from the electricity supplier. It may be government or it may be private. There will be a single bill and there is a rate charged per number of units consumed. What management can do is they can put submitters to various departments and accordingly they can charge based upon the rate whichever is charged by the department on energy, that can be charged to various departments. Selling expenses, discounts, bad debts, selling commission, all this on the basis of sales of each department. Here, if there is any direct selling expense, then the question of discussion does not come here. This is common expenses. See, suppose a company is giving a branding or an advertisement for that product, but that cost can be divided among the various departments on the basis of the sales of each department, because this is selling expense, so they have considered, they are saying you divide on the basis of sales. Next, carriage inward and discount received. Suppose an organization is procuring material from one vendor. In that case, that vendor, he is sent the goods together to the organization, to the business, and that goods are being used among various departments. If they are being used among various departments, then the cost of that particular carriage has to be allocated to various departments. So that is based on the purchases. Because this is related to purchases, they are saying you divide the cost on the basis of purchase. Suppose department A had purchased 500 rupees worth of goods, and department B has purchased 1000 rupees worth of goods, and they have spent 100 rupees. For example, they have spent 100 rupees and department A purchased 500 rupees worth of goods and department B purchased 1000 rupees worth of goods, then it has to be divided like this. For example, this is example. See, this is the total transportation cost, and this is the value of goods purchased by department A, and this is the value of goods purchased by department B. So I have purchased 500, so 500 divided by 1500, so whatever is the cost, that I will bear it, and here I will pay 2/3, because they have purchased goods worth of rupees 1500. So like that, it can be allocated on the basis of purchases, similarly on the basis of sales in the earlier point. Next, coming to wages or salaries. These are common wages or salaries which are spent generally to all the departments. In those cases, it is on the time basis. They can maintain the time sheet and accordingly they can do it. Otherwise, again it will be on the basis of total cost incurred by respect to departments if time sheets are not maintained. That can be decided by the management of the business. Then depreciation, insurance, in this case value of the assets they have used or time they have used that particular asset. Next, administrative and other salaries cost. This is again time basis. See, it is very difficult to allocate time for these expenses. Say for example, directors. Can directors say I have spent so much time on this department, so much time on this department, who will record, how it is possible? He keeps thinking various other aspects for any department, who will record the timing? Basically, it is not possible. In that case, management can decide any rational basis on which that can be divided. That is the reason I told in the beginning, it is not the harsh and fast rule that this cost has to be divided. This is only a theoretical. You have to think, the management has to think on what basis any particular cost can be divided, and whichever is more rational, that basis can be chosen, and accordingly the cost can be divided among the departments. Labor welfare expenses, number of employees, because it is related to salaries. Same way PF, ESA, again it is related to salaries on the time basis or on the basis of wages, it can be divided. Now there may be certain other expenses which cannot be allocated only. In those cases, it will be directly debited to profit and loss account of the organization. There won't be any allocation for those expenses. Now let us understand what is the basis on which the inter-department transfers are done. As we said, the product or service may go through various departments before it is sold to outside public. In that cases, there is a cost incurred at various departments, and that cost is being transferred from one department to another department. So the basis of transfer cost may be three. It can be either of the three ways. One is, say, on the cost basis. How? Suppose department A is transferring goods to department B. Department A will arrive the cost of manufacture or cost of that particular product, and at the same cost they will transfer to department B. This is one way of transferring the cost. If they are transferring on the basis of the cost, then there is no question of markup value or loading or profit element. So there is no question of complication here. Suppose if management decides, for the purpose of evaluating the performance of any particular department, the material has to be transferred from one department to another department on the basis of market price. Market price means, suppose at any intermediary stage of that production point, if that product or semi-finished product, if it is sold outside market, how much it can be fetched, then that price is called market price. So management decides to transfer the goods at the price at which that particular product fetches in the market. At the same price, it has to be transferred to the next department. Then the selling price of that particular department will be the market price, and that price will be charged to the other department, and the other department will take it as a cost in its departmental accounts, and it will do further processing. That is another method of transfer of material from one department to basis of transfer of material from one department to other department. Next, cost plus agreed percentage of profit. Say management doesn't want to get into complication what is the market price, because if you see, the market price can be little more or less depending upon the vendor, all the combinations, purchase, quantity of material purchased, all these things are there, which market price is a more dynamic, and it is not very, we can't say that the price of this product today in the market is this. So that is the reason they may say, okay, let us have a fixed percentage of loading on the cost, and that price will be the purchase price for the next department. In that case, say for example 100 rupees is the price, the management decides that 10% is loading or 15% is loading, then the 10% means 100 rupees plus 10 rupees will be taken as a cost to the other department, and that will be the selling price of this preceding department. Accordingly, they can do the transfer. This is another basis on which the goods or services transferred from one department to another department. Now let us understand how this profit element. See, basically why I am saying this profit element is the department has transferred that particular price to next department. Now whether the business has gained anything? No, because it is transfer of material from one department to another department. There is no actual realization of profit. It is unrealized profit. Unrealized profit. See, one department to another department within the same organization is taking the material from one hand to another hand at a higher value. Is there any profit earned by the organization? No. So this particular transfer is being done at a profit element is only to evaluate the performance of respective departments. There is no earning of profit. So at the time of preparing the financials, it may be monthly, depending upon the organization, it may be monthly or yearly basis. This profit element which is not realized has to be ignored, has to be eliminated from the profit and loss account. So how that unrealized profit has to be identified. This can be identified like this. I have shown you the example. Now I will show you one example for this. Say for example, department A is there and department B. A sends goods at 15% margin to department B. Like say 15% means it falls under this kind of cost plus agreed percentage of profit. So in those cases 100 rupees plus 15 rupees, then it will send goods at 115 rupees. So this will become 115 will become selling price of department A, and 115 rupees will become selling price of department B. Now, at the time of recording the purchase by department B, it should carefully record 100 rupees at cost and 15 rupees is stock reserve. This is called stock reserve. Because it is inter-department, they know what is the markup in this material. So they should record it. If they don't record like this, what will happen at the year end when management asks department B, what is your closing stock? Then it will say by 115 rupees. So the closing stock is more, then obviously it will impact the profitability. Profit is more. Actually, it is a notional profit. There is no profit only. First of all, it is not sold. It cannot be realized in cash also in lifetime. So that is the reason they have to very carefully record this as 100 rupees cost and 15 rupees as stock reserve. When year end comes, then this 15 rupees has to be eliminated. Suppose in a given problem, they say 15 rupees is the margin and closing stock at department B is 5. How will you arrive at this 15 rupees? In the problem, they may not give you this much clearly that 15 rupees is the profitability element. In that case, what you have to do, you know this figure and you know 15%. So how you have to arrive is 115 rupees into 15 divided by, this is the stock 115, that means 100 plus 15. So then you will get this 15 rupees as the markup. Okay, whatever may be the closing stock into markup value divided by 100 plus markup value, you will get the profit element in the closing stock that you can identify what stock reserve. Once you arrive at the stock reserve, you have to take two general entries. What are the two general entries at the year end? Is one is at the year end, one is at the beginning of the year end. Year end will be stock reserve account debit to first entry will be profit, and because it is not profit and loss account debit to stock reserve account. See, we said profit element is included in the stock. Closing stock is shown in credit side. So you have to debit profit and loss account to reduce the element of profit in the closing stock and take it to stock reserve. So this 15 rupees will be taken, 15 rupees at the year end. At the year end, this 15 rupees will be reduced from the closing stock and it will be taken to stock reserve. Then at the beginning of the next year, again the cost of department B will become 115 only. The cost of department B is 115 because they have purchased the material at 115 rupees from department A. So they have to reverse this entry. Stock reserve account debit to profit and loss account 15 rupees. In this case, 100 rupees of closing stock of previous period will increase by 115 rupees, increased by 15 rupees, and opening stock will become 115 again. That is the way how it has to be accounted. Now let us see how this is disclosed in balance sheet at the year end. At the year end, in balance sheet, it has to be shown closing stock 115 less stock reserve, which is a credit balance 15 rupees, and outer column 100 rupees. This is the way it has to be disclosed in balance sheet. So the important point you have to note it here is how to arrive the stock reserve. See, all the things are journal entries. It is very simple. Now what is the formula to arrive at stock reserve? So the formula to arrive at stock reserve is transfer price of unsold stock into profit included in transfer price divided by transfer price. Transfer price of unsold stock into profit element in transfer price divided by transfer price, you will arrive at stock reserve. So this is how the basis on which the interdepartment transfer happens, or three methods, and how to arrive at stock reserve, and what are the journal entries, and how it is disclosed in the balance sheet, or main aspects of departmental account. It is very simple chapter, easy to understand, and you may expect even 10 marks question in this in CA intermediate. So please focus on this chapter, it is easy. Thank you.